inventories, don't forget, this is a component of GDP that needs to come down a lot. Inventories are at cycle peak. So we completely disagree with any notion that GDP is going to recover because of inventories. When people have too much inventory, they have to take it down. If you've never run a business, you have no idea what I'm talking about, and that's usually why people who are in central planning have no idea on this. See that? That's a chart, the inventory to sales ratio at retail, going back all the way to the prior crisis. Look at what inventory the pink line did going into and out of the crisis. Zoom. Again, inventory to sales ratio. So the point here is that companies don't see the macro coming in as much as bad economists don't. Inventories are too high. Demand doesn't meet, again, those levels of inventory. They have to mark it down, which you can see at every store in America right now, including Chipotle, and they have to mark it down. And what happens is that they get margin compression. S&P 500 earnings and operating margins, again, one is a function of the other to some extent, particularly at the cycle high. S&P 500 log scale earnings and operating margins are coming off their all-time highs. That's one of the most obvious reasons why you should be selling stocks. Again, when a company, think about it like a company, they have peak earnings and then and growth, and then all of a sudden they tell you that they're not going to grow as fast. See the rate of change of my hand go like this off the roller coaster top? You know, it's hard to kind of get the roller coaster to stop when the first part is over the top. That's why we use the cartoon. Again, that's why we're bearish on multiple compression. Josephine showed that chart. Multiple compression hasn't really happened yet as the earnings are coming down. So again, it's one of the most obvious, blazingly obvious reasons to sell. Again, sell, we put that in there as opposed to buy stocks.